aqui, é um prazer ter vocês todos. Eu vou fazer a introdução em inglês. I'm gonna continue in English to do the presentations. Good afternoon, ladies and gentlemen. It is a great honor to welcome here Dr. Dudley here in Brazil to be our keynote speaker this afternoon. As you know, Bill is the 10th President and Chief Executive Officer of the Federal Reserve Bank of New York since January 27, 2009. In that capacity, he serves as the Vice Chairman today and a permanent member of the FOMC, that you all very, very familiar. Dr. Dudley has joined the New York Fed in 2007 as Executive Vice President and head the markets group. I must say that Bill Dudley is a renowned policymaker. All these years we had to design new emerging lending facilities, important monetary policy measures, some completely new, so you had to drive it, implemented by the Federal Reserve in the aftermath of the great financial crisis, and Bill has been there exactly in that time that you really need all these instruments. If it was important in one side, now it's important in the other side on how do you normalize it. And Bill has been instrumental in the normalization of monetary policy, and why not in the rollback of the Fed balance sheet to be in a very prudent, very well-communicated measures. I must say that we here in Brazil have benefited from the good communications of the Fed. The fact that the normalization has been quite smooth now for several years. I would say not only the US, but the global system has benefited from well-communicated, very few bumps, and we're still in this process. So I would like to thank in public for this very well managed normalization. The topic today, as I understand, is trade and globalization. The topic has always been the focus of policy discussion everywhere. But lately, I will say that the interest on these issues has increased for obvious reasons. So I'm really eager to hear from Dr. Dudley on this matter. Central Bank of Brazil and Fed New York has been a relationship for some time, if not for the fact that our reserves are well guarded at the New York Fed. You know that we have like 90% of our reserves very well guarded. I must say from an institution point of view, we are very happy. We have been there a key partner on the transactions. It has been smooth. We even collaborated. My team has been saying that we have been collaborating over the last years in different system development, so that has been quite important. Besides the Fed, I must say that I'm happy that Bill has been a colleague at the board of the BIS. We meet 5 times a year, 6 times a year, 5 times in Basel, 1 time somewhere else. Last time was Japan, a bit far. This time we benefit is in Buenos Aires, but we both have this somehow same time zone, so we feel each other's enthusiasm. And I must say, and I was just joking in the room, is that we both are in a committee, the audit committee of the BIS that meets at 7:45 a.m. in Europe, which is for us is like 3 o'clock in the morning. It's crazy, but we have managed to do our job. Unfortunately, though, as you may all know, Bill is leaving the Fed and the BIS in the coming July. I have very much appreciated the opportunity to work with William as a board member at the BIS, and certainly he will be missed by everyone. his extensive experience as a policymaker, expertise in central banking, his excellence in conducting strategic matters, and policy direction have been valuable for everybody. Thank you, William, for accepting our invitation. After your presentation, Carlos will moderate. Please, William, the floor is yours.
I think I wish my mother was here. Those are very kind remarks. Well, it's a pleasure being here, to be back here in Brazil. This is a very important relationship for us and one that we want to continue to grow and develop over time. And thank you, Ilan, for having us and the Central Bank of Brazil for organizing this event. You know, it's a pleasure to have this opportunity to talk about globalization. This, as Ilan has noted, this is a really important issue, especially at the current time. As always, what I have to say today will reflect my own views and not necessarily the views of the Federal Open Market Committee or the Federal Reserve System. So although the debate about the benefits and challenges of globalization is not new, as Ilan noted, it has come into a sharper focus. And I think this debate is important to all of us. And I think it's particularly relevant to Brazil, given its importance in the global economy. Globalization means different things to different people. So in my remarks today, I'm going to focus on the role of globalization as a force for international economic integration and economic development. I'm going to highlight three themes. The first is the important role that trade plays in promoting higher standards of living globally. The second is how changes in trade can create challenges for industries and their workers when they lose competitiveness. Insufficient attention, I think, has been given to this issue, and I think we must do better because the very large costs at times can be imposed on particular communities and households. The third, I think the answer to these challenges, though, is not greater protectionism. Instead, I think we want to provide greater support to displaced workers so they can obtain the skills they need to find good, well-paying jobs. And we also have to ensure that there are strong global institutions and international cooperation to help manage the consequences of globalization. And I think this includes responding to the challenges stemming from financial globalization. By that I mean the flow of capital across national borders. Now, these issues are important to me as a central banker because I think they affect the long-term health and productivity of the U.S. economy, the economic opportunities available for our people, and I think the efficiency and stability of the global financial system. Now, the debate around globalization, particularly in advanced economies, I think reflects many factors. Undoubtedly, the global financial crisis and the subsequent slow recovery have been important factors. But just as important have been some other longer-term trends, such as growing income inequality, the loss of middle-income jobs, and the rise of large emerging market economies, such as what we've seen in India and China. Although the debate about globalization is not new, I think we're at a particularly important juncture, because if support for liberalized trade and an integrated global economy were to suffer a significant setback, the consequence, in my view, would be slower economic growth and lower standards of living around the world. Now, while considerable effort has gone into liberalizing trade and developing the existing set of trade improvements, that doesn't mean that what we have is perfect. I think we can improve on what we have. I think some of these trade agreements could be enhanced and updated. Some may not adequately address some recent changes that we've seen in the global economy, for example, the rise of digital trade, and may need to be refreshed as a consequence. And important trade barriers still remain that I think should be addressed. In particular, and this is from a U.S. perspective, the access of U.S. firms to some foreign markets and the protection of intellectual property rights I think are issues that deserve close attention. But in addressing these issues, we should also take care to preserve the vital benefits of trade to higher standards of living in both advanced and emerging market economies. So our focus should be on strengthening an open trade regime as appropriate and amending and improving the existing agreements that we have. So to begin, let me just briefly describe the pace of globalization so you have a good sense of what's actually at stake. Global economic integration has increased dramatically in recent decades. So trade in goods and services, for example, was 40% of GDP in 1990, stands at 54% of GDP in 2016. And over the same period, the stock of foreign direct investment has increased dramatically from roughly 10% of GDP in 1990 to 36% today. So put simply, we have national economies and financial systems that have become more integrated and more interdependent. It's a global economy, but a bunch of national countries and systems. This rapid growth in trade, I think, reflects a number of things: falling trade barriers, declining transportation costs, and improved information and communication technology. And I think these trends have enabled very complex global supply chains to emerge that allow companies to manage their production more efficiently. At the same time, this is not a story really about advanced economies. It's really more a story about emerging market economies, because they now make up a much larger share of global trade, the global economy, and of global economic growth. So just as an illustration, if you look since the great financial crisis, emerging market economies have accounted for 70% of global economic growth over the last 10 years or so. That's double their share from 2 decades earlier. And this growth has provided much needed support to the broader global economy because the advanced economies recovered only very slowly from the financial crisis. Now, rising economic integration is also evident when we look at the bilateral relationship between Brazil and the United States. So in 1994, bilateral trade flows between the U.S. and Brazil were 17 billion. Now they're 57 billion. So that's a pretty dramatic increase. And the United States is Brazil's second largest export market, and it's an important destination for manufactured goods. In 2016, the stock of U.S. direct investment in Brazil was 64 billion, compared to 18 billion in 1994. And recent initiatives announced by the Brazilian authorities, including a large and transparent infrastructure concession program and greater foreign participation in the oil and gas and in the aviation industries, I think those underscore the potential for further increases in foreign direct investment in the years ahead. Increased trade, through its longer-term impact on productivity, I think has been a key contributor to global growth and prosperity since the Second World War. Openness to trade brings many benefits to the supply side of the economy, and these include larger markets, greater specialization opportunities, and the increased ability of firms to exploit economies of scale and scope. This also allows faster transmission of technology and innovation, and interesting, greater competitive pressure on domestic firms, which force those firms, therefore, to raise their productivity. So what happens is these forces collectively lead to a much more efficient allocation of a country's scarce resources, one that aligns what the country does with its international comparative advantage. As a consequence, consumers benefit from lower prices, higher real incomes, and a greater variety and quality of goods and services. And increased openness may also have another benefit. It may reduce wasteful rent-seeking behavior on the part of protected industries and the related costs of corruption that are often associated with such behaviors. When we look around the world, openness to trade has certainly played a very important role in the economic ascent of Asia that we've seen in the last few decades. Following the rise of Japan, Korea, Taiwan, and others, we've seen fast growth in China and India, which has lifted literally hundreds of millions of people out of poverty. And that's really an unprecedented feat in human history. Reflecting these gains, a number of emerging market countries now have become strong supporters of open trade. And I think that's quite different than the situation a few decades ago. Benefits from open trade are also very much evident in Brazil. Following its dramatic trade reforms in the 1990s, productivity growth in Brazil increased. Brazil has also leveraged its ample and diverse natural resource endowments to becoming a leading exporter of iron ore and a number of agricultural products. And the country has benefited from the rise of China. Total export volumes more than doubled between 2000 and 2010 and have now nearly tripled. Brazilian multinational companies are also important global players in industries such as mining, metals, food, paper products, and transportation equipment. But unfortunately, the increased openness to trade is not a panacea in and of itself. Actual benefits depend on a range of other factors. These include macroeconomic policy, the business and regulatory environment, the legal and tax regime, labor and product market flexibility, and the quality of infrastructure and public services such as education. While the gains from a liberalized trade regime are not guaranteed, the alternative of trying to achieve a high standard of living by following a path of economic isolation will fail. Trade has played a key role in nearly all of the high-growth success stories that we've seen since the middle of the last century. It's important to recognize that while trade and international integration tend to increase the overall economic pie, the distribution of this larger pie may be very uneven. In fact, slices for some particular groups may even shrink. Some workers, particularly in those in industries that are less competitive and whose skills may have become less relevant, can be hurt and can find adjustment difficult. Successful adjustment often requires individuals to change industries and to relocate to different regions. So while trade is almost always a win for a country's economy, not everyone within that economy will necessarily be a winner. This is especially the case where the policies to cushion the negative consequences of trade and to facilitate adjustment are either lacking or are inadequate. Such effects are country and industry specific, and they do depend on the initial endowments and conditions. Low-income workers in emerging markets, for example, may actually find it more difficult to adopt given weaker safety nets and fewer financial resources available to deal with adverse economic shocks. The bigger and the harder the adjustment process, the more the gains from trade will tend to be eroded. Now, while the rise in the skill premium from trade liberalization has been well established for both developed countries and emerging market economies, determining the aggregate impact of trade on jobs has been more challenging, and to date the evidence has been mixed. I think we need further research in this area to determine with more confidence a reasonable range of estimates for these employment effects. All the evidence of the extent to which jobs have been lost due to global trade is inconclusive. It's certainly true that the job losses that are attributed to trade tend to be viewed very differently. That is, they are seen as being lost to foreigners and often viewed as a consequence of the policy decision to liberalize trade in the first place. The challenge of adjusting to open trade is a serious issue that I don't think has received the full attention it deserves. This may partly reflect the fact that the burden is borne unequally and it's spread out over a long time period. It also may reflect the fact that the winners from trade have often tended to have stronger voices than those who have been the losers. Research has documented that the effects on individuals of job dislocation, including those that result from trade, can be significant and long-lasting. Older workers tend to suffer larger earnings losses and often face more difficult transitions. Put simply, displaced workers may not have the appropriate skills to find good jobs in other areas of the economy, including in growing export sectors. When the affected industry reflects a large share of a particular local economy, the situation is even worse. The damage is often magnified. In this case, the burden can become more widespread as the level of wages across the community, not just in the affected industry, is negatively affected. And this doesn't begin to capture the full human toil, including the impact on workers who have lost confidence in themselves and in their futures, and the poor health outcomes that often occur because of increased stress. Research on Brazil has found that workers employed in regions facing larger tariff cuts experience declines in formal sector employment. They also didn't generally migrate to more favorable regions. Instead, they either became unemployed, moved to the informal sector of the economy, or when they turned out to be more fortunate, moved into another sector within the same region. We should find better ways to help communities that are struggling because of the effects of free trade. In the United States, we've historically experienced a high degree of geographic labor mobility, much higher than in many other advanced economies. And that helps. The ability to move in search of better opportunities when possible has helped mitigate some of the adverse consequences of trade. But mobility in the United States has actually declined in recent years, implying that the adjustment cost to trade in the U.S. may have increased. So given these costs of global integration and more liberalized trade, what is the best path forward? Although protectionism can have a siren-like appeal because of its potential to provide short-term benefits to particular segments of the economy, in the longer term, it will almost certainly be destructive. Countries need to compete better, not compete less. Trade barriers are a very expensive way to preserve jobs in less competitive or declining industries. They blunt opportunities in export industries, and they reduce the affordability of goods and services for households. Indeed, such measures often backfire, resulting in harm to workers and resulting in diminished economic growth. A better course, I believe, is to learn from our experience. From a U.S. standpoint, we should work to reduce the remaining foreign trade restrictions that impair our ability to capitalize on our comparative advantages. For example, market access restrictions can mean that certain U.S. industries cannot realize their full potential. Similarly, weaknesses in the protection of intellectual property rights limit the ability of U.S. producers to realize the full returns from their investments. This lowers their profits and diminishes their incentives to grow their businesses, and that then has consequences for how many people that they can employ in the future. If we're going to enhance the benefits of free trade and better manage the costs, it's critical that we also continue to strengthen the global rules-based system. On the positive side, I would point to the World Trade Organization's Trade Facilitation Agreement, which addresses custom procedures, and this could reduce global trade costs significantly. But at a broader level, I think we have to recognize the momentum behind global trade reform has clearly waned in recent years. This has occurred even though there are a number of areas that would actually benefit from further reforms, such as agricultural and services. I think that momentum needs to be rekindled and reaffirmed. Although advanced economies historically have tended to lead the way, it's important that large emerging market economies now play a greater role. And I think this is appropriate given their growing prominence in the global economy. Now, there are many approaches to dealing with the cost of globalization, but believe me, protectionism is a dead end. Trade restrictions address the symptoms and not the underlying problems, and they introduce their own sets of costs and distortions. While such measures might generate a temporary boost to growth from greater domestic production and consumption, these would likely be offset by a range of other costs. Over time, such measures would retard productivity growth, and that would shrink the economic pie. Think, for example, of some of the import substitution models that were pursued by many emerging market economies, including Brazil, following the Second World War. Those eventually led to poor economic outcomes. And those poor economic outcomes in Brazil was what helped trigger the reforms of the early 1990s. In assessing the benefits and costs of trade, it's important to understand that the nation's trade balance, this is really important, reflects more than just what's happening in terms of trade policy. Just as important are the country's savings and investment spending proclivities, and those are affected by many things such as tax policy and fiscal policy. For example, in the United States, we have a chronic trade deficit, and we have it because domestic investment spending exceeds our domestic savings. Foreign capital inflows make up the gap. In this process, the foreign exchange value of the dollar plays an important equilibrating mechanism. If the domestic savings investment imbalance is unchanged, then any reduction in the trade balance from higher trade barriers will need to be offset by lower imports. The domestic currency will appreciate to cause the trade deficit to widen back to where it was before to accommodate the desired capital inflows. Thus, at the end of the day, trade restrictions affect the composition of trade, but not the gap between exports and imports, because that's determined by the difference between domestic savings and investment. So at the end of the day, the protectionist country would produce more goods in sectors protected by higher trade barriers, but it would also produce fewer goods for export. The expectation that higher trade barriers would save jobs ignores these critical second-round effects. Moreover, the story may not end there. What happens if another country that now faces higher trade barriers responds by raising its own barriers? The outcome would be countries producing more where they have a competitive disadvantage and less where they have a competitive advantage. That's the exact opposite, of course, of what we should be aiming for. For example, in the United States, one of our largest manufacturing exports is aerospace parts, which obviously requires lots of skilled labor. And one of our largest imports is apparel, which requires less skilled labor. It would be unfortunate if we switch that mix. These second-round effects would also likely hurt productivity growth. Scarce resources would be used less efficiently, and trade protection would likely lessen the level of competitive pressure that's useful in helping drive innovation. Moreover, lower productivity growth would also likely to lead to a slower improvement in the nation's standards of living over time. So rather than protectionism, a better policy would be to help domestic workers and companies compete more effectively rather than compete less. We need additional mechanisms that allow us to more fully capture the benefits from liberalized trade and to more proactively mitigate its costs. Ideally, policy should also better address job losses and income inequality, not just from trade, but also from automation and other technological advances. How we respond should depend on regional and industry circumstances. These include the nature of the trade impacts, the skill sets and locations of the workers that have been affected, and the amount of resources that we can mobilize to facilitate adjustment. Increasing specialization does bring real economic benefits, but it can also leave workers more exposed to shifts in the demand for their services, and that can potentially occur on very short notice. These issues are not going away, especially as emerging market economies take on a larger role in the global economy and automation continues apace. If we are to maintain a more open trade regime, globalization must be socially and politically sustainable. And for that to be the case, we have to provide greater support to those who are hurt by trade. Policies should include more assistance with job retraining, help with job search and mobility, and broader unemployment support. We also need to do more research into what measures have been effective in economies around the world, and I think we should encourage greater experimentation. Getting the balance right between providing assistance and making sure that the individuals hurt by trade can get back on their feet and achieve their earnings potential, that's going to be a challenge. And we need to have a better understanding of actually what works well in that process. More generally, we need to do a better job positioning our workforce to cope with globalization and technological change. So improvements are needed across a range of areas, not only education and training, but also the business regulatory environment and infrastructure investment, because greater infrastructure investment could support greater worker mobility. These measures would also promote higher productivity growth. While the scope and scale of issues differ substantially by country, I'm sure many of these issues are also relevant for Brazil. Now, there are various measures available in current trade agreements, such as anti-dumping measures and countervailing duties for dealing with unfair trade, as well as escape clauses that provide safeguards for industries that face a sudden surge of imports. Again, the challenge is to ensure that such measures are effective and that they facilitate rather than retard adjustment, and that they're not abused so just to avoid foreign competition. But both sanctions and temporary relief have been provided for in the global trade rules, so we should be willing to use them when their use would lead to more equitable outcomes and would help sustain political support for a more open trade regime. Financial globalization, this is the flow of capital across national borders, is also an important issue that must be considered. These flows help to support global economic integration in the trade of goods and services. This is a large, complex subject, and one the Central Bank of Brazil is well acquainted with, having successfully managed the pressures of heavy capital inflows followed by sharp reversals. The tremendous damage of the global financial crisis really underscores the importance of this issue. As with issues related to trade, achieving effective financial globalization requires robust and mutually supportive measures at both domestic and international levels. First, the high level of cross-border capital flows and their potentially volatile nature further underscores the importance of solid domestic fundamentals, including exchange rate flexibility, a credible monetary policy framework, a sustainable fiscal policy, sufficient foreign exchange reserves, and a strong financial system. In this process, I think the United States has a special responsibility to keep its own house in order, given the large size of our financial markets and the U.S. dollar status as a reserve currency. Indeed, the U.S. financial system, unfortunately, was the epicenter of the global financial crisis. I believe that promoting economic growth and financial stability at home in the United States is the most important contribution that the U.S. can make to promoting growth and stability worldwide. Now, with that in mind, and Elon talked about this in his introduction, U.S. monetary policy can have a significant impact on global financial conditions, including exchange rates, and shifts in U.S. monetary policy can lead to consequential shifts in global capital flows. Therefore, good communication and transparency from the Fed is essential. And in this respect, I think we've made a number of improvements in recent years. We're certainly trying that have helped facilitate smoother market adjustments to policy changes. One example, Elon alluded to this, is the process by which we began the normalization of our balance sheet last year. We foreshadowed our intentions to begin balance sheet normalization, and we initiated a program that was very transparent in terms of its design, and then when we began it, we ramped it up very, very slowly. While the Federal Reserve has a domestic mandate set for it by the United States Congress, so we have to do what's right for the United States in terms of sustainable employment and price stability, we also have to be mindful of the international effects of our actions, because they can have important consequences for the global economy and for financial markets. A high level of global interdependence also requires robust cooperation and effective international institutions. So that's why Elon and I go to Basel 5 times a year to discuss economic, monetary policy and regulatory policy with our fellow central bankers. This dialogue, supported by ongoing bilateral discussions between central banks, I think really does help build trust, understanding, and the kind of valuable relationships that are crucial, especially when we get into periods of crisis and stress. The global financial crisis put the need for a more robust and resilient financial system in stark relief. We have to have a robust financial regime in place if we're going to be able to maintain the flow of credit to the real economy, both domestically and internationally, during times of stress. Over the last decade, policymakers have implemented a range of reforms that I think have materially strengthened the banking system, including higher capital and liquidity buffers for internationally active banks. International cooperation, I think, has been really important to successful implementation of these reforms. You know, banking is a global business, and that requires a high level of regulatory consistency and as level a playing field as possible to avoid distortions and regulatory arbitrage. Under the auspices of the Basel Committee on Banking Supervision of the BIS, we've seen a wide-ranging set of reforms which we have been introducing progressively, and that included just recently the finalization of the Basel III reforms. Tighter regulation of international banks must also be complemented by effective supervision. And I think we've made a lot of progress in improving the cooperation between home and host countries in terms of supervisory oversight. In a local context, cross-border supervisory coordination has taken on increased importance because Brazilian banks have expanded internationally considerably in recent years. Still, we do need to have greater clarity about how large global banks will be resolved if one were to fail, if we're to successfully end too big to fail. So this is still an area of work. Finally, it's increasingly clear to me that we also need to develop a better shared understanding of the proper role of exchange rate policies and reserve accumulation in a healthy and fair global trading system. To be sure, in a world of volatile capital flows, experience has shown that having adequate reserve cushions has helped many emerging market economies ward off costly instability. Indeed, Brazil's large stock of foreign exchange reserves has been a key pillar of stability through turbulent periods. But reserves are a relatively expensive form of insurance, and excessive reserve accumulation can undermine global adjustment, it can shift burdens onto trading partners, and it can potentially erode the political support for continued trade openness. As I've said on other occasions, I think part of the solution here lies in further improving the international safety net so that countries have a more efficient and less costly ways of ensuring their resilience. So to conclude, although the benefits from open trade regime remain compelling, we also must recognize that from time to time, such a regime does impose costs, and those costs need to be addressed more forcefully. Focusing on these costs, I think, is necessary if globalization, including its financial dimensions, are to work for all of us. So thank you for your kind attention.
So we now have a little time for questions. Bill kindly agreed to answer some of them. There are some microphones around, and so if you'd like to ask a question, I ask you to please raise your hand and identify yourself, and someone will bring a microphone to you. But I want to exploit my position here to start with a question, if you allow.
We're colleagues.
Yes.
Carlos worked at the Federal Bank.
I'm an alumni of the New York Fed. Very, very proud to have worked there. One thing that's kind of troublesome in this effects of globalization on welfare are these long-term, these very persistent effects. And I do know that for Brazil that there's evidence. I think you alluded to maybe the paper that I have in mind showing that even maybe more than a decade after the opening and the effects of trade on some particular locations, you do see effects of that shock still impacting the local economies. Now it's, of course, if you're just thinking in very theoretical terms, it could be that people don't move because the costs are very high. It could be also that they don't perceive very high benefits, maybe because of lack of knowledge or of other opportunities and means to go seek those opportunities. So I don't know if in the U.S. there's already more knowledge of how what's really happening in this case where there are very, very persistent effects of these trade shocks.
Well, as I said in my speech, I mean, mobility in the U.S. is better than many other countries, but it's still not particularly good. I mean, it's understandable. People want to stay with their family, they want to stay with their friends, and so moving to different regions to take advantage of opportunities is a it can be a difficult and lonely step. And I think that's why I think that more support needs to be given to either encourage that leap of faith or to help the local economy that's been damaged by the trade pressure. It's definitely challenging. I mean, the U.S. I mean, I think we have probably a little bit better tradition of adjustment. I mean, because we're a nation of immigrants. I mean, most people came to the U.S. and their ancestors came to the U.S. because they were seeking greater opportunity. So that if you're moving from one country to another, I would hope you could move from one state to another. But this is something that is definitely a problem. I mean, you look at some parts of the country where technological change, more than globalization, has really eroded competitiveness. It's been very, very tough for people in those areas to find good opportunities. And the other challenge, of course, is what time does this happen in your career? If you lose an opportunity when you're 25 or 30, you still have a pretty long trajectory ahead, and the incentives and willingness to tool up and gain new skills is probably much greater than if you're 55 or 60.
Thanks. A question here, Marcelo.
Thank you so much for your comments. We woke up this morning with the news wires and everybody talking about the U.S. government slapping tariffs on steel and aluminum. I would like you, if you could share your views of how could this actually interfere with the normalization policy or the process of normalizing monetary policy in the States.
Well, I'm not going to speak directly to steel and aluminum tariffs, but obviously more broadly, I mean, to the extent that if tariffs go up, it will, at the margin, tend to put more upward pressure on prices. And those upward pressure on prices will have to be considered by the monetary authority in terms of how they set monetary policy. So clearly, it's one of many, 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 many things that go into the monetary policy, evaluation process. But at the margin, I would say more trade barriers, less free trade will tend to diminish productivity growth over time and will tend to raise prices and therefore inflation. So it works in that direction.
Adeodato. If you
Thank
could
you, sir.
introduce yourself briefly.
I'm
mention the institution.
Adeodato Neto. I'm a chief strategy for a full research, independent research company here in Brazil. You just said that U.S. monetary policy can change global capital inflows. Like when we look at a benefit global scenario where major economies grow at similar paces and you have aligned monetary policies and stuff. From a trade standpoint, when you see like fiscal decisions and trade barriers being taken by the U.S., wouldn't that, from your view, force the FOMC to take decisions that shall unbalance this trade levels, this balanced actually trade levels, and consequently impact negatively in the U.S. on export and import by harming another economies that are growing, that are developing in a better place and balanced place, inclusive because of how the rhythm of normalization is being taken in the U.S.?
Well, the monetary authority is the monetary authority. It doesn't have control over a number of other policy levers like immigration policy, trade policy. So we take the world as it is. Our job is pretty well defined by Congress in terms of maximum sustainable employment in the context of price stability. So we have an employment goal and inflation goal. To the extent that things happen in the world that make those goals harder or easier to attain, we obviously have to take those into consideration in our conduct of monetary policy. But we very much try to stay out of the political process. We want to, we're an independent central bank that's focused on monetary policy, and so we're not going to opine about, should you do X or Y on fiscal policy, should you do X or Y on trade policy. I will. At the same time, though, we're going to point out, a general thrust of policy that we think is likely to be more successful rather than less successful. And as I hope my remarks today made clear, I think we think that open trade policy supplemented by more attention to those who are hurt by trade, and I think that's the important thing I want to emphasize, will be better because it will provide more political support to sustain a regime of open trade. And if we don't take better care of those people hurt by trade, then the political consensus to support open trade will fray, and then we can end in a much poorer environment. So that's really what the point, I think, of the speech today is, sort of say there's two ways you can go. And I think far better is to go down the path where you maintain the consensus in favor of open trade, but recognizing that you have to do something to maintain that. You can't just sort of count on the fact that there's going to be support for open trade when so many people over time have been hurt by that and by technological change. I mean, a lot of times these two things are conflated. Trade and technological change, and I think if you did a very careful evaluation of the stress on employment in the U.S., I think you'd probably find that the technological change was probably the more important piece. But these two are used sort of interchangeably.
So would that be reasonable to say that policymakers are now in the U.S. focusing more on the political side of view of their decisions? I mean, from a trade barrier standpoint, other than trying to extend the length of this stability and this balanced global capital flow?
Well, I think the Fed wants to extend the global expansion, and we want to preserve a system where capital can move freely around the world. I think we're actually in a pretty good place right now, frankly. If you look at the global economic environment, growth is, everywhere. I mean, it wasn't in Brazil a year or two ago, but now Brazil is also experiencing a cyclical recovery. So pretty much everybody in the world is growing right now. There's very few exceptions in terms of major economies. So we do have a synchronized global economic upturn. That's actually a good thing, and I think it actually provides maybe support for sustaining this open trade regime, because you can see some of the benefits that are occurring in the global economy. So I'm pretty upbeat about the global economy, and that's one reason why I'm pretty confident that the U.S. economy is going to continue to perform pretty well over the next year or two. Supplemented by still what I would view as a still accommodative U.S. monetary policy. And now on top of that, and I think this is the new piece, a pretty large move towards fiscal stimulus, both in terms of the tax legislation and then the increase in spending caps for domestic discretionary spending and for defense spending. So fiscal policy is in the process of turning quite stimulative. And so any worries you had about U.S. economic growth, which I think were already pretty subdued, I would think in the near term should be even more subdued, because I think you have quite a bit of impetus to growth. U.S. economy was in good shape already, fiscal stimulus, global economy is doing well. That all, I think, makes me pretty confident the U.S. economy is going to continue to grow.
Aqui na frente, por favor.
You have someone back there.
I want to ask you about long-term impact of globalization, trade, technology on our main goal of inflation. There have been quite a bit of debates over the last 10 years, 20 years, from saving led to secular stagnation, effects from technology, Amazon effects, or where do you stand in terms of all these long-term effects on our job of looking for inflation?
Yeah, I think in terms of the secular stagnation, Florida, that's a story that somehow we're just going to grow very, very slowly for a very long time. Interest rates are going to be very, very low, and inflation's going to be very hard to get back to in the advanced economy world, back to our inflation objectives of around 2%. I'm less convinced by that argument, in the sense that there's a competing alternative explanation, which is that we had a financial crisis, and then we had a great recession. And that temporarily really damaged household and business confidence and caused it very hard for the global economy to get back on track. Now I think finally the global economy is back on track. And so I think the competing story is just that, yes, we did have a long hangover from the financial crisis and the Great Recession that follows, but now that pallor over the global economy is now lifting. And so maybe the secular stagnation story is going to turn out not to be the right story. So I'm not sure at this point, but I want to hold both sort of actively in my mind as possibilities. And obviously it would be better if it was the financial crisis storm clouds are abating than the secular stagnation story. But we'll see. The big uncertainty, I think, in the advanced economy world is what are the implications of the changes in the demographic trends? In terms of the facts, for example, in the United States, the working age population isn't growing very fast anymore, or at a more extreme level, Japan. And so there's really a question, I think, a fundamental question is, how important are demographic trends in terms of influencing economic activity, inflation, and potential growth rate? And I think, we know which direction it works in, but I don't think we have a very good sense of how powerful it is. And that's sort of a question I think we're going to answer over the next few years. In terms of the Amazon effect, I think Amazon has helped people get more transparency into pricing, but it's hard to argue that this is a very large effect in the sense that because Amazon has existed for years, and so to really say it's having a huge effect on inflation now, you'd have to say that its effect this year is large and much greater than the effect last year. So I think it does have some effects on good prices. When we look around the United States, what we see is very weak goods prices and moderate growth in services. So there's a pretty big gap between goods prices and services prices. It's always been the case because productivity growth in manufacturing is higher than productivity growth in services. But it also may be exacerbated by the Amazon effect. So I think the jury's out on that as well. I mean, Amazon is pretty important in the U.S. economy in terms of changing the nature in terms of how goods are priced and sold. But it's still pretty small relative to this huge scale of the U.S. economy, and year to year, it's growing rapidly. But I think the effects are probably pretty modest. Would be my own judgment.
Thank you.
Hi, Jason. I'm Chief Economist for Infinity Asset. When talking about globalization, one aspect we see in many countries, like Japan in the half of the past century, they were basically manufacturing low-cost products, selling to the world. They evolved to a better quality of environment in their own country, and now they actually are no longer manufacturing and they're a service provider. The same way is happening to the US. The same happened to Korea, and now it's happening to China. We see China much concerned about environment. We see the change in the profile of what we see in China nowadays. What's going to be the future when there's no longer countries left for making things, for making a production of low-cost things?
I think there's still plenty of room to go before we exhaust that margin. I mean, people are looking out from China to other emerging market economies, especially in Asia. So I think there's still plenty of room. And of course, that's not the only dimension by only margin on which one can operate. Also, to the extent that standard of livings rise in the world and wages go up, well, then there'll be more impetus for automation and substituting capital for labor. So I'm not, I don't think we've gone through the end of that process.
It's a long-term question.
Yeah, I guess I'm relatively optimistic about this. A lot of people have this view that somehow, automation is going to lead to mass unemployment, and I suppose it's possible, but people have been telling this story for about 2 centuries now. In the United States, if you go back to look at the United States, 150 years ago, something like 90% of the economy was in agriculture. Today, it's about 1 to 2% in agriculture, and we sort of manage that transition. So I think that humans are very clever in developing new goods, new services, new things to do, and with that, I think there'll become lots of employment opportunities. So I'm definitely not a Malthusian.
Just another question, bringing it to the present day. Thinking about the policies that President Trump is proposing right now of returning industries to the United States, manufacturing to the United States. There's a point also about manufacturing is the environment liabilities. Would be the U.S. prepared to return off all those industries like they're in China, having this liability?
Well, I mean, the issue of environmental conditions in emerging market economies that produce goods that for export to the U.S. does come up from time to time in the U.S. discussion, because people on the labor side say, we're bearing costs of production in terms of environmental protection rules that these competitors aren't subject to. So it's certainly an issue. What typically happens, though, I think, is as economic countries develop, their demand for a clean environment goes up along with their economic development. And you can see right now what's happening in China. I went to Columbia my freshman year of college in New York City in 1970, and there were many, many days where one could not see across the Hudson River to the other side. It was so polluted. So, as countries get richer, the environment becomes more important to them, and so cleaning up the environment sort of becomes front and center. And so I think there's a natural process where, I think you'll see, China, continue to take steps to improve their environment, and I think that's just a natural part of economic development.
Thank you.
Couple more questions. One. Okay, now there's more hands there, here, and also then Marcelo here at the back.
Hi, Daniel Meisman from Verde Asset Management, Brazil. If I can deviate a bit from trade and go to monetary policy, and taking a hint of what you said just a few moments ago, what we had like back in December of last year was an economy that was growing consistently around 2.5% in the U.S. And we had in the SCP a bunch of forecasts for trade for rates normalization that would go like 3 hikes this year and about 2 hikes next year. And then on top of that, we had a huge fiscal stimulus, both from the tax reform and then the spending cap being raised. And then I wonder how that has changed your view on the likely path for monetary policy. And on top of that, if I just can add a little issue, which is the financial conditions are extremely low. I mean, they're extremely easy for the time being. And usually what we had in the past is that when you hike rates, then the currency appreciates a bit, and then it carries a bit of the burden of cooling down the economy. And then since now we don't have the currency appreciating anymore, it's quite the opposite. It turns out that the monetary policy has to carry all the burden of cooling down the economy. And I wonder if you could comment on those issues. Thank you.
Well, before the fiscal stimulus package, the tax legislation, and the spending, because we thought the economy was going to grow above trend, and we thought that we were going to have to gradually remove accommodation in 2018. Now we're even more, confident in that. If you remember at our last FOMC meeting, the statement inserted the word "further" in the statement, further interest rate hikes, and I think the notion of that is just, at least in my mind, I'm just speaking for myself, not speaking for the FOMC, is I have greater confidence that the economy is going to grow above trend. I have greater confidence that the Fed is going to have to continue to gradually remove monetary accommodation. Whether that necessitates a faster pace of tightening, I think that still remains to be seen. One reason for why that's still, I think, an open question is, one, the economic outlook is always uncertain. So you can have a forecast, but your forecast is going to be disappointed a high percentage of the time. And two, the fact that inflation is still below our 2% objective. If you look today, we got the personal income consumption expenditure deflator numbers, and still, I think on a year-over-year basis, if I read my BlackBerry correctly, we're running 1.5% on a year-over-year basis for we look at core personal consumption expenditures, not because we don't care about food and energy, but because we think this is a more stable predictor of future inflations, and our inflation objective is 2%. So inflation is below our objective, and in that environment, it's hard to really be aggressive, I think, or it's hard to come up with a reason to be aggressive in terms of the pace of monetary policy tightening, because you haven't gotten back to your inflation objective. And we've been underperforming our 2% inflation objective for a number of years now. So, we have to also be conscious of the potential consequences of that. If we don't get inflation back to 2%, or maybe even a little bit above 2%, that could cause inflation expectations to become unanchored relative to our 2% target, and that would not be a good outcome. So it's important that 2% is our objective. It's a goal that's symmetric. We're just as unhappy, or a little bit above 2 as below 2. If we're at 1.9, 2.1, that's I'd love to stay in that area for a very, very long time, but it's not a ceiling. It's really important to understand that 2% is not a ceiling. That's where we're trying to go there, and that's where we want to stay over the longer run. But if it went a little bit above 2, I don't think it would be a huge consequence.
4 hikes a year, is it aggressive in your view?
You know, I mean, I think you'd have to ask different people. I think that, in my own view, you know, if you were to go to, you know, 4 25 basis point rate hikes, I think it would still be gradual. I mean, I think, you know, we don't define exactly what gradual means, but if you look at the, you know, the hiking process in the last cycle, it was a quarter point at every meeting, so it was basically 8 hikes a year, and so I would hold that as the alternative to gradual.
Okay, Marcelo had a question here. Let's go with Leandro just for ease of the mic, but then someone could get a mic over here to Marcelo.
Okay, so Leandro Rottmiller, Chief Economist of Bocom BBM. So thanks, Carlos. So I have a question on China. So I'd like to come back on China a little bit. I'd like to hear your thoughts on how China has dealt with its challenges since 2015. So the Fed tried to start hiking rates in 2015. China is a large economy with a less flexible exchange rate regime. It had some challenges back then. So how do you see China dealing with that, and how has been the coordination between the Fed and the PBOC on that sense, the dialogue between those two countries? So this is it. Thanks.
Well, we see Governor Zhou in Basel on a very regular basis, and I've seen it elsewhere a number of times as well. I mean, it's a really important bilateral relationship of the U.S., and so we keep very in close touch with our Chinese colleagues. I think that, you know, generally they're in a reasonable place. You know, I think they've done a good job with their foreign exchange regime. I mean, I think initial days were a little bit bumpy because there was a lack of understanding about what the new regime was going to look like. But I think, you know, more recently over the last year or so, I think you've seen, you know, there's not a lot of you know, issues about, you know, what China's trying to do in terms of the currency policy. The foreign exchange reserve holdings have, you know, they declined quite significantly, but now they've stabilized and even increased. So it all seems, you know, in a good place. The issue for China, I think, is the broader issue for China is really a bigger one and a hard to analyze one, which is credit has been growing, you know, quite a bit faster than GDP for some time. And the corporate credit burden is quite large, and historically that's usually not led to good outcomes. The second thing, as part of that, is that the shadow banking system in Japan has grown very large and very rapidly. Now, on the good news side, I think the Chinese absolutely recognize these problems, and they're trying to address them. And I think they've really gotten their arms around some of the issues on the shadow banking side over the last year or so. So I think they're making progress, but, you know, it is a little concerning when debt's growing much faster than GDP for year after year after year. That usually doesn't lead to a particularly good outcome. So it's something that, you know, I think, you know, not just us, but I think people everywhere around the world, you know, are wondering about, you know, can this be brought down, you know, soft landing, you know, successfully. You know, good news is they're very highly capable policymakers, and the good news is they very much recognize the issues that they face. So, you know, I don't think anything, you know, bad is going to happen imminently, but they still have this problem, which is a significant problem to address.
Okay, let's go with Camila here. Sorry, I didn't see your hand before, and then Marcelo.
Thank you very much for the presentation. Camila de Faria Lima from Canvas Capital. There has been some debate about the expected increase in U.S. twin deficits and its relationship, the relationship between this trend and monetary policy and the dollar. Could you please share your views on this issue? Thank you.
Well, we're going to run the experiment and find out, aren't we? I mean, the budget deficit is probably going to go to something on the order of 5% of GDP, you know, in 2019, I would guess, something on that order. I mean, I'm still waiting for the official figures to come out from the congressional budget offices. They're taking on board all these changes that have happened, and, you know, I'd like to see what they show. so the budget deficit is going to be moving upward. It's happening at a probably a somewhat problematic time in the sense that there's going to be further pressures on the budget caused by higher interest rates, higher debt service costs. The U.S. debt burden has roughly tripled over the last 10 years, but the debt service costs have barely moved up. They've moved up a little, but it's on the order of 10, 15%. And that's all because of the low level of interest rates. So as we normalize interest rates, the debt service costs are going to go up pretty dramatically, and so that's going to have another set of pressures on the budget deficit. And the last issue, which is something we've obviously known about for a long time, but it's now here, is the retirement of the baby boom generation, which is a very large cohort of which I am one. And when I and others of my age group retire, we're going to be asking for Social Security and Medicare spending, healthcare benefits, and there's going to be a lot of pressure on entitlement spending. Now Brazil has some, also thorny issues in the Social Security space. But these are things that both our countries have to wrestle with. So we're starting with a pretty high budget deficit, pretty deep in the cycle, with debt service costs and entitlement spending still to come on top of that. So I think it's going to be quite challenging. How it plays out in terms of the twin deficits, we'll have to see. Historically, what's happened is as the budget deficits go up, if domestic savings doesn't rise accordingly, then the current account deficit has to expand to make up that gap. So that we'll have to see how domestic savings responds to the fact that the budget deficit is increasing. That will be the key element, I think, that will drive how that adjustment process occurs. We know the identity. We know how it has to add up, but we don't have a good sense of which pieces are going to move the most to facilitate that adjustment.
Okay, let's take.
Now it's my turn.
Okay, so, sorry, Marcelo. We'll take a last question from Marcelo.
So, it will be a little bit different from the previous one. I just left the financial sector. Now I'm in the academia. I'm professor of Fundação Getúlio Vargas here in São Paulo. And one of the topics that I'm researching is cryptocurrencies. So my first question, I try not to be complete out of the context of the conference, so I would ask you the effects of cryptocurrencies on trade, on globalization. But what I really want to know is pick up your mind about the role of Fed and central banks in general on the regulation and issuance of cryptocurrencies.
Well, this is a topic that central bankers are really in the process of trying to get their arms around. There's work going on in the international fora and in various national economies. I'm not I really would want to distinguish between the currency and the technology. I'm not a big fan. I've been pretty clear on that about Bitcoin. It's not legal tender. It's not a stable form of value. It's not stable, so this doesn't have the attributes like of a currency. And it's actually not a very efficient mechanism as a payments medium either. It's slow and expensive as a payments medium. So not big fan of Bitcoin in particular. But the technology of blockchain and distributed ledger is interesting. In terms of having a decentralized way of having confidence in data integrity. And I think it's really going to be interesting to see how this evolves to as more robust cryptocurrencies get developed that actually are more stable, are more efficient in terms of payment execution, that have less element of speculative media attached to them. So I think there is something. I think there. I certainly wouldn't want to say that there's. This is a dead end. It's not. It's not clearly a dead end because the technology of blockchain and distributed ledger, I think, is quite interesting. A lot of companies are looking at that for security settlement and other kinds of way of keeping very complex data records. So I think we'll have to see how it evolves.
Okay, please join me in thanking Bill Dudley for a great talk and answering our questions.
Thank you.